U.S. stocks have rallied almost 50% since their March lows. And while a lot of strategies have worked, which one should you pursue in the weeks and months ahead? Well, for that answer, then that question, let's bring in Bloomberg's Zara Burton, who has more on what one Oppenheimer strategist recommends. Zara.
Hi, Susan. We're talking about growth versus value stocks. These are the stocks that look cheap based on what they're trading at versus those stocks that are still able to grow their business with above average sales. Now, if you look at this chart, let's pull this up. You can see that value stocks, the blue line there, have actually underperformed growth stocks, that's the white line, and the broader S&P 500, this since the start of the year. Value gaining about 6%, the S&P up about 11%. Growth stocks, again, doing the best of the lot in the white line, climbing about 15%. Brian Belsky, though, over at Oppenheimer, he's chief investment strategist. He says the trends that have supported these growth stocks, they're starting to reverse. And these are typically a slump in share prices and the economy, slower earnings growth, and increased stock market volatility. So those are some of the major benchmarks. Now, we're starting to see signs of stabilization in the economy. Share prices, of course, they're coming back. And let's look at volatility, because the VIX index, which measures that volatility, now trading way below where it was. This is back in October, during the height of the financial crisis, when Lehman failed, AIG was near failure. And Belsky says that as those trends, even as the VIX rather, trends even lower, that value stocks will start to outperform. Now, he may have history on his side, because what Oppenheimer did, they did an analysis of each S&P 500 bear market, this since 1980. And what they found was that the S&P 500 value index outperforms the growth index by significantly wide margins for up to 18 months following a bear market bottom, and that the gains, as you can see from this chart, get incrementally better leading up to those 18 months. So we're starting to see that with value stocks recently. They've actually led the rebound from the March low. But Belsky says it's still early days into this cycle. Investors still have time to reap benefits from shifting into value shares. There you can see up 55% for value stocks since the March low. Susan.
Yeah, Zara, so if value stocks are going to outperform the growth stocks, I mean, did Oppenheimer come up with any specific names?
Yeah, they did actually. Couple sectors, couple sector picks, couple stock picks especially. And they not just looked at value stocks, but those with positive year-over-year free cash flow per share growth and positive expected 2009 earnings growth. 5 of the stocks, including on that list, you had Citrus Systems. As you can see, it's still up big time, 55%. So far this year, they think it still has more to run. DirecTV, BMC Software, Oracle also on that list, already up 26%. Coca-Cola Enterprises doing quite well, as well, up about 58%.
Okay, Zara, thank you for that. Zara Burton with a look at value stocks maybe outperforming growth stocks. That's according to Oppenheimer. Though if you want to get into the market, we have some other views thinking if you're wanting to put money into this recent rally, you may want to hold off, because according to market forecaster Elliot Wave International, the gains lack technical strength. Let's take a look at the MSCI Asia Pac Index. It has retraced 50% of the losses that followed its all-time high reached back in late 2007. That's as measured on a Fibonacci scale. But if you look at the recent rally up from the lows in March, you see some small waves, 5 of them, with the July wave being smaller than the advance before. And according to Elliot Wave International, that indicates that the rebound is only the first leg of a larger bear market rally. And it also highlights the lack of strength in the current move upwards. So since the March lows, the Asia Pacific benchmark has gained over 60%.